Imagine owning shares of 3 world-changing companies for less than $3,000. Right now, the market is offering rare bargains on industry leaders. Today I'll reveal a travel titan making a massive comeback, a gig economy pioneer reshaping how we move and eat, and a digital payments giant processing billions daily, all trading at dirt-cheap prices. This isn't just about cheap stocks, it's about overlooked value with huge upside. We'll break down the numbers, growth prospects, and why these stocks could transform your financial future. I've done the research. These are opportunities you don't want to miss. Grab a pen, hit like, and subscribe so you never miss a crucial investing update. Let's dive in. First up is Carnival Corporation, ticker symbol CCL, the undisputed heavyweight of the cruise industry and the world's largest cruise line by far. With a fleet that spans the globe and a legacy stretching back decades, Carnival has become synonymous with the modern cruise vacation, offering unforgettable experiences to millions of travelers each year. The market's been harsh on cruise stocks since the pandemic, with many investors still haunted by memories of empty ships and shuttered ports. But Carnival's business is not just recovering, it's surging back with a vengeance. Occupancy rates are now at or even above pre-pandemic levels, and guests are spending more than ever on board, setting new records for revenue per passenger. The energy on Carnival ships is palpable, with every sailing packed and vibrant. Cruises offer unbeatable value, especially in times when consumers are watching their wallets and seeking affordable escapes. For the price of a single hotel night in many cities, guests can enjoy an all-inclusive vacation at sea, meals, entertainment, and exotic destinations all bundled together. This value proposition is driving a powerful wave of demand, with bookings for 2025 and even 2026 already looking robust. Families, couples, and solo travelers alike are locking in their next adventure, eager to make up for lost time. Of course, Carnival wasn't immune to the challenges of the pandemic. The company took on significant debt to weather the storm, ensuring it could survive the industry's darkest days. But now, management is aggressively paying down that debt, fueled by a surge in cash flow as ships return to full capacity. Their plan to strengthen the balance sheet is already well underway, with billions in debt retired and more to come. This financial discipline is restoring confidence among investors and analysts alike. Despite these improvements, the stock is still priced as if Carnival is stuck in crisis mode. The market's narrative hasn't caught up to reality. While the business is clearly in growth mode, the share price remains depressed, creating a classic value opportunity for those willing to look past the headlines. It's a disconnect that savvy investors recognize, a chance to buy a world-class company at a bargain. Carnival's modern, efficient fleet gives it a significant cost edge over competitors. The company has invested heavily in new ships that are not only more fuel-efficient but also packed with amenities that attract every type of traveler, from families seeking fun to luxury seekers craving relaxation. With 9 distinct brands under its umbrella, Carnival appeals to a truly global audience, offering everything from budget-friendly getaways to high-end voyages. Of course, risks remain. The travel industry is always vulnerable to global shocks, be it health crises, geopolitical tensions, or economic downturns. Another unexpected event could temporarily disrupt demand, but history shows that the cruise industry is remarkably resilient. Time and again it has bounced back stronger, fueled by people's enduring desire to explore the world by sea. Carnival isn't standing still. The company is investing in cutting-edge technology, like its medallion-class wearable devices that personalize the guest experience and streamline operations. Sustainability is also a top priority, with new ships featuring advanced energy systems, solar panels, and cleaner fuels. Carnival is positioning itself at the forefront of the experience economy, where memorable moments and seamless service drive loyalty and repeat business. As Carnival's debt falls and profit margins improve, earnings per share are set to climb. Analysts are beginning to take notice, but the broader market's negative narrative is outdated. The company's financials are turning a corner, and the potential for upside is significant as sentiment shifts. Buying CCL now is like snapping up prime beachfront property after a storm, before the crowds return and prices soar. It's a rare window of opportunity for investors who can see past the temporary clouds and recognize the long-term value. At the helm is CEO Josh Weinstein, whose leadership has been nothing short of impressive. His team is executing flawlessly, focusing relentlessly on guest experience, operational efficiency, and financial health. Their disciplined approach is winning back both customers and Wall Street skeptics. The stock has been quietly building a base, consolidating as the business fundamentals improve. For patient investors, this is often the setup for outsized gains as the market eventually catches up to reality and sentiment shifts from fear to optimism. Carnival's unmatched scale, powerful brand portfolio, and operational momentum make it a textbook turnaround play. Few companies have the global reach and brand recognition that Carnival commands, and even fewer are positioned to benefit so directly from the return of travel demand. the market is missing the recovery story here. While headlines focus on past challenges, the numbers tell a different story, one of recovery, resilience, and renewed growth. Smart investors can get in before the inevitable re-rating, capturing value that others are overlooking. This is a classic contrarian bet, but the data is on your side. When the crowd is still fearful, opportunity knocks for those willing to do their homework and act with conviction. Carnival's combination of a deeply discounted valuation, record-setting demand, and rapidly improving financials is a rare find in today's market. It's not often you see a company of this scale trading at such a steep discount to its true potential. The company is, in effect, buying back its own future at a fire sale price, reinvesting in the business, retiring debt, and setting the stage for long-term growth. As the balance sheet strengthens, the potential for shareholder returns only increases. For patient investors, Carnival could emerge as one of the most compelling turnaround stories of the decade, a company that not only survived unprecedented challenges, but is now poised to thrive in a new era of travel. That's why Carnival is our first dirt-cheap stock to buy now, a rare blend of value, growth, and resilience, all wrapped up in one of the world's most iconic travel brands. Let's move on to the next opportunity and see where value awaits. Next up is Uber Technologies, ticker symbol Uber, a company that has completely transformed the way we move, eat, and connect with our cities. Uber isn't just a ride-hailing app anymore, it's a global technology powerhouse that has redefined transportation and delivery for millions of people around the world. From its humble beginnings as a simple idea to get a ride at the tap of a button, Uber has grown into a multifaceted platform that touches nearly every aspect of urban life. In its early years, Uber was all about rapid expansion and market share, burning cash to outpace competitors and establish itself as the go-to choice for rides and food delivery. But today, Uber has entered a new era. The company is now a cash-generating machine, posting consistent profits and robust free cash flow quarter after quarter. This shift from growth at all costs to disciplined profitability marks a major turning point in Uber's story, and it's one that many investors are just starting to appreciate. Despite these impressive financials, the market hasn't fully caught on yet. Uber's stock recently took a dip after earnings that were misunderstood by Wall Street, creating a rare buying window for savvy investors. This kind of market overreaction is exactly the opportunity long-term investors look for, a chance to buy a high-quality business at a discount. Uber's core businesses, mobility and delivery, are both firing on all cylinders. Ride-sharing demand has rebounded strongly as cities reopen and travel returns, while Uber Eats has become a daily habit for millions of people. The company is also expanding Uber Eats beyond just restaurant food, moving into groceries, convenience items, and even retail delivery. This diversification is turning Uber into an essential part of everyday life for users around the globe. What really sets Uber apart is the synergy between its platforms. The more users who rely on Uber for rides, the more likely they are to use Uber Eats or try new services. This creates a powerful network effect where each new user adds value for everyone else. It's a virtuous cycle that strengthens Uber's competitive moat and makes it harder for rivals to catch up. And let's not forget Uber Freight, a sleeper growth engine that's quietly targeting the massive trillion-dollar logistics market. By connecting shippers with truckers through its digital platform, Uber Freight is bringing the same efficiency and transparency to logistics that it brought to ride-sharing. This business is still in its early days, but it has the potential to be a major driver of growth in the years ahead. Uber's global reach is already impressive, with operations in over 70 countries and hundreds of cities. Yet the company still has huge international expansion potential. Many markets remain underpenetrated, and as urbanization accelerates worldwide, Uber is well-positioned to capture new users and expand its footprint even further. One of the most telling signs of Uber's transformation is its first-ever share buyback program. This move signals management's confidence in the company's future and their belief that the stock is undervalued at current levels. It's a strong message to investors that Uber is not just focused on growth but also on delivering value to shareholders. Of course, regulatory risks are always a concern in this industry, but Uber has proven time and again that it can adapt to new rules and work constructively with governments around the world. Whether it's navigating labor laws, safety regulations, or local licensing requirements, Uber's ability to evolve and find solutions has been a key factor in its resilience. Uber's brand is so strong it's become a verb. When you need a ride, you Uber there. When you're hungry, you Uber Eats your meal. This kind of brand power is rare, and it gives Uber a deep moat that's hard for competitors to breach. The company's app is often the first and only choice for millions of users. Advertising is another exciting growth lever for Uber. The company is just beginning to tap into this high-margin revenue stream, leveraging its massive user base and data to deliver targeted ads across its platform. As this business scales, it could become a significant contributor to Uber's bottom line. Uber's transformation is real. The company is now disciplined, profitable, and still growing at an impressive pace. Management has focused on operational efficiency, cutting unnecessary costs, and prioritizing sustainable growth over reckless expansion. The result is a leaner, stronger Uber that's built to last. The recent pullback in Uber's stock price is a gift for long-term investors. It's not often you get a chance to buy a market leader with this kind of growth potential at a discount. For those willing to look past short-term volatility, the risk-reward profile here is extremely attractive. Uber is a dominant force in two massive markets, mobility and delivery. But the company's ambitions don't stop there. With multiple growth levers, including logistics, advertising, and new service lines, Uber is building a fortress balance sheet and positioning itself for years of expansion. CEO 𝗗𝗟𝗏𝗧 leadership has been instrumental in this turnaround. His focus on profitability, smart expansion, and disciplined execution is paying off. Under his guidance, Uber has become a more mature, resilient, and innovative company. Don't let short-term noise or market headlines distract you. The fundamentals here are strong, and Uber's long-term growth story is just getting started. The company's ability to adapt, innovate, and execute gives it a clear edge in a rapidly changing world. Uber is no longer just a rideshare app. It's a global tech platform offering a suite of services that touch transportation, delivery, logistics, and more. With a massive addressable market and years of growth ahead, Uber is positioned to be a key player in the future of urban living. The current valuation is compelling for a company of Uber's scale, reach, and potential. As more investors recognize the company's transformation and growth prospects, there's significant upside ahead. That's why Uber is our second dirt-cheap stock to buy now, a rare opportunity to own a global leader at an attractive price, with years of innovation and growth still to come. Our third pick is PayPal, ticker PYPL, the digital payments pioneer now trading at a bargain. Once a Wall Street darling, PayPal has seen its stock price tumble, but beneath the surface, the company remains a foundational player in the global shift toward cashless transactions. If you've ever shopped online, sent money to a friend, or paid for a service with just a few taps, there's a good chance PayPal was involved. PayPal's stock has been crushed, down over 80% from its highs. But the business remains a global payments powerhouse with over 400 million active accounts. That's more than the population of the United States, and it's a testament to how deeply PayPal is woven into the fabric of digital commerce. The company's reach extends to every continent, and its services are trusted by consumers and merchants alike. The market's pessimism is overdone. PayPal processes more than $1 trillion annually and is essential to e-commerce worldwide. Every second, thousands of transactions are completed using PayPal's secure platform, making it a critical infrastructure provider for the digital economy. As online shopping continues to grow, PayPal's role only becomes more important. The company owns Venmo, the top peer-to-peer app for younger users, with untapped monetization potential. Venmo isn't just a way to split dinner bills, it's a social payments platform that's become a verb for an entire generation. As PayPal explores new ways to monetize Venmo, from branded debit cards to in-app shopping, the potential for revenue growth is significant. New CEO Alex Chriss is refocusing PayPal on innovation and execution, rolling out AI-powered products and a faster checkout experience. Chriss brings a fresh perspective and a track record of driving growth at previous companies. Under his leadership, PayPal is investing in artificial intelligence to fight fraud, personalize user experiences, and streamline operations. The company is also revamping its checkout process to make it even faster and more seamless for both consumers and merchants. This is a transition year, streamlining operations and setting up for renewed growth. PayPal is cutting unnecessary costs, focusing on its core strengths, and building a foundation for the next phase of expansion. The company is also working to improve its relationships with merchants, offering new tools and analytics to help businesses grow. PayPal is trading at a low double-digit forward PE, despite strong profits and billions in free cash flow. This means investors are paying a modest price for a company that generates substantial earnings and has the financial flexibility to invest in growth or return capital to shareholders. In a market where many tech stocks trade at sky-high valuations, PayPal stands out as a rare value opportunity. Aggressive share buybacks at these levels are highly accretive, showing management's belief in the company's value. PayPal is using its cash to repurchase shares at a discount, effectively increasing the ownership stake of remaining shareholders. This not only signals confidence from leadership, but also sets the stage for outsized returns if the business rebounds. PayPal's platform-agnostic approach and trusted brand give it a powerful network effect with merchants and consumers. Whether you're shopping on a small business website or a global marketplace, PayPal is often the payment method of choice. Its reputation for security and ease of use keeps both buyers and sellers coming back. International growth is still in early innings, especially in emerging markets. As more people around the world gain access to smartphones and the internet, the demand for digital payments is exploding. PayPal is expanding its footprint in countries where cash is still king, positioning itself to capture the next wave of global commerce. Competition is real, but the digital payment space has room for multiple winners. Rivals like Apple Pay, Square, and Stripe are formidable, but PayPal's scale, brand recognition, and global reach give it a durable edge. The market is growing fast enough that several companies can thrive, and PayPal's established user base gives it a head start. The risk is execution. Can the new CEO reignite growth? At this valuation, much of that risk is already priced in. Investors are skeptical, but that creates an opportunity for those willing to look past the headlines and focus on the company's underlying strengths. If management delivers even modest improvements, the upside could be substantial. Even modest improvements could trigger a major re-rating. If PayPal can stabilize its margins, accelerate user growth, or unlock new revenue streams, the market could quickly reappraise the stock. History shows that sentiment can shift rapidly when a company surprises to the upside. PayPal is not broken, just out of favor. It's a cash machine with a huge user base and a strong balance sheet. The company's fundamentals remain solid, and its ability to generate cash gives it options. Whether that's investing in new products, making strategic acquisitions, or returning capital to shareholders. The market is pricing in zero growth, but any positive surprise could send the stock soaring. When expectations are this low, it doesn't take much to spark a rally. For investors with patience and conviction, the risk-reward profile is compelling. This is a classic value play, a dominant leader at a multi-year low, with a new CEO and a coiled spring setup. The ingredients are all here: a strong brand, a massive user base, a history of innovation, and a management team with something to prove. Ignore the headlines. Look at the fundamentals. The noise around PayPal's challenges has drowned out the company's strengths, but savvy investors know that sentiment can change quickly. The fundamentals tell a story of resilience and opportunity. For patient investors, PayPal offers world-class fintech exposure at a fire sale price. It's rare to find a company with this kind of scale, profitability, and growth potential trading at such a discount. If you believe in the future of digital payments, PayPal deserves a spot on your watch list. The risk-reward is heavily skewed to the upside. With so much negativity already reflected in the price, the potential for outsized gains far outweighs the downside. This is the kind of setup value investors dream about. That's why PayPal rounds out our list of dirt-cheap stocks to buy now. In a world that's moving rapidly toward digital payments, PayPal's combination of scale, innovation, and financial strength makes it a compelling opportunity for long-term investors willing to look beyond the current noise. There you have it, Carnival, Uber, and PayPal. 3 dirt-cheap stocks with huge upside. With $3,000, you could build a diversified portfolio of these high-potential names. The key to wealth is buying great companies when they're out of favor, being greedy when others are fearful. Do your own research, but the risk-reward on these stocks is compelling. Want to level up your investing? Check out my Value Stocks Investing Master Course. Link in the description. For exclusive tips and analysis, join the Stocks Galore Patreon community. Which stock are you most bullish on? Let me know in the comments, hit like, and subscribe for more investing insights.